Welcome back to the Duck Dive. You're listening to Talk Tickers, where we try to cut through the noise on corporate earnings calls and give you the really critical insights.
And today we're digging into the Q4 2025 results for a radiation therapy company. It was, well, a genuinely complicated quarter.
Yeah, definitely not straightforward.
No. Our mission here is to quickly unpack this story. It's got everything, global friction, big balance sheet moves, and maybe, just maybe, a turn towards better operational performance.
And you saw that complexity reflected right away in the market reaction, didn't you? Stock popped after hours, then sort of drifted down the next day.
Exactly. That tells you the market saw the good stuff, the resilience on the top line, but was also weighing those near-term profit pressures.
Okay, so let's hit those headline numbers. What did we see?
So revenue landed at $127.5 million. That was actually a solid beat versus the $123.8 million consensus. So demand, or at least shipments, looked okay.
Okay, revenue beat, good start. But wait a second. The GAAP EPS that came in at just wire 1 cent missed the 0 under 3 expectation pretty clearly.
Doesn't that immediately make you think, maybe they had to spend a lot or discount heavily to get that revenue? How solid is that top line if the profit isn't following?
That's exactly the right question to ask. And look, the adjusted EBITDA also dipped slightly year over year, down to $9.4 million from $10.1 million. So your skepticism is definitely warranted there. But the narrative from management, and there's some support for it, is that it's more about timing and these external cost pressures, not necessarily just buying revenue.
Okay, so what supports that narrative?
Well, operationally, the book-to-bill ratio was still healthy at 1.2. That means future orders are still coming in faster than current revenue. Demand seems okay underneath.
Right, 1.2 is pretty solid. That points to future revenue. Now, what about cash? They ended with $58 million, but that was down sequentially.
Yeah, it was down. But they were very clear. This wasn't about, say, out-of-control capital spending. It was specific costs, fees tied to that big debt refinancing they did.
Okay. The cleanup cost money. Exactly. And also investing in working capital. They basically had to build inventory buffers and manage logistics differently because of all the global supply chain issues they faced. It cost cash to stay flexible.
Got it. So navigating the storm had a price. Let's talk about how they navigated it then. Overall revenue was down 5% year over year.
It was. But you really have to look under the hood, as they say. The picture is split. Product revenue got hit hard, down 11% year over year to $70.7 million. That's where you see the direct impact of those train problems, the shipping delays.
Ouch, 11% down on product, but there must be a but.
There is. The but is service revenue. That side of the house actually grew 4% year over year to $56.8 million. And in this kind of choppy environment for big capital equipment sales,
the service piece becomes incredibly important, right? It's the anchor.
It's the absolute anchor. That steady recurring revenue is what provides stability when product shipments get volatile.
And did that stability flow through to margins?
It absolutely did. Gross margin actually improved, up 200 basis points year over year, hitting 30.6%.
Wow, okay. So overall revenue down, but gross margin up. How did they pull that off?
It wasn't volume. It was almost entirely driven by really impressive performance on the service side. Service gross margin jumped 9 full percentage points.
9 points. That's huge. What drove that?
2 main things, they said. Lower consumption of spare parts, which could mean better product reliability, or maybe just better inventory management.
Or both.
Or both, right. And successful pricing actions on service contracts. That tells you they have some real pricing power there, which is, a great sign.
Definitely a strategic plus. Okay, but we still have that overall profitability issue, the EPS miss. You mentioned timing.
Yes, the China timing issue. This is a specific point they highlighted. They said about $1.7 million in higher margin revenue got deferred. It sort of slipped out of Q4 and into future quarters.
Why? What happened?
It was due to a really rapid shift in where sales were happening near the end of the quarter. Geopolitics basically forced them to quickly reroute shipments out of the EMEA region, Europe, Middle East, Africa, India, and into China.
Okay, I have to ask again. It's not just, convenient timing, pushing something less profitable out of the quarter.
It's a fair question. They insist it's purely about revenue recognition rules tied to those specific geographies and the timing of installations or acceptances. The key claim is that the margin isn't lost, it's just delayed.
And when do they expect to recognize it?
They guided for it to start positively impacting adjusted EBITDA in the first half of fiscal 2026. So relatively soon. If they hit that, it supports the timing, not lost business's argument.
Okay, we'll watch for that. Now, you mentioned geopolitical friction and balance sheet moves. Let's talk about that balance sheet overhaul. It sounded pretty major.
It really was. Felt like a major strategic step. They basically decided they couldn't keep navigating this kind of global uncertainty with their old capital structure. Right. Time to clean house.
So what did they do specifically?
They completed a big debt refinancing. They took $82 million of convertible notes off the table, paying with a mix of cash and stock. And crucially, they entered into a brand new $190 million secured credit agreement.
With a strong partner, they emphasized.
Yes. And this does two big things. Extends their debt maturity out by 5 years, which is huge breathing room.
Right. Takes that near-term pressure off.
Exactly. And it significantly boosts their liquidity position. It really signals a shift, I think, from just surviving quarter to quarter to managing for the longer term and focusing on execution.
And they certainly needed that flexibility. Given the environment they described, it sounded like pure chaos on the trade front.
Oh, it was supply chain whack-a-mole.
Yeah.
Seriously. First, you had those incredibly high U.S.-China tariffs, 145%, 125%, just crippling.
Yeah.
Then, seemingly overnight, those got slashed to just 10% reciprocal tariffs. So boom, China shipments were back on.
Okay, good news, right? Start shipping to China again.
You'd think. But no sooner did they get those channels flowing than unexpected unrest flares up in the Middle East, and bam, trade in the EIMEA region just halts.
Wow, so they were constantly redirecting things.
Constantly. Pivoting shipments almost weekly, it sounds like. And that's why they ended up with this $4 million run rate cash impact from tariffs in Q4 alone. Even with the lower China rate, the disruption cost them.
So are they just accepting that tariff cost going forward, or are they doing something about it? Especially since, what, 80% of their sales are international?
No, they're actively working on mitigating it. Two key things. First, they're activating what's called the duty drawback program.
Okay, what's that?
Simply put, it lets them reclaim duties they paid on imported components if the final product using those components gets exported out of the U.S. again, since most of their sales are export.
That could actually claw back a decent chunk of cash.
Potentially, yes. Yeah. It helps manage the cash outflow, but the bigger, more structural solution they're working on is establishing a foreign trade zone, an FTZ.
Right, the FTZ. Explain that a bit more. How does that work, and why is it such a potential game changer for them?
Think of an FTZ as like a little bubble, geographically inside the U.S., but legally considered outside U.S. customs territory for certain purposes. By setting one up at their main manufacturing site in Madison, which they expect to do by the second half of fiscal 2026. They can bring in components, assemble their machines, and then ship them internationally without those components ever officially entering U.S. commerce from a customs perspective.
So they could potentially avoid paying those import tariffs altogether on goods destined for export.
That's the goal. It could be a fundamental fix to that part of their cost structure, neutralizing a big chunk of that tariff headwind.
And that $4 million impact in Q4, did they manage to offset any of that already?
They did. They said even with just the initial actions, like starting the duty drawback process, they managed to mitigate about half of that cash impact in the quarter. So the FTZ holds the promise of tackling much of the rest.
Okay, that's a clearer picture on the cost side.
Right.
Now let's pivot to the future. The guidance. You said the market reaction was mixed, but the guidance itself sounded pretty positive.
It did. They provided what looks like strong guidance for fiscal year 2026. They're projecting revenue between $471 million and $485 million.
And profitability.
Adjusted EBITDA projected between $31 million and $35 million. If they hit that, it implies some pretty significant operational leverage kicking in next year compared to where they are now.
What gives them the confidence to project that kind of jump?
The backlog, primarily. They ended Q4 with $427 million in backlog. Now, that is down about 12% year over year.
Okay. Down 12%.
Yeah, but it still represents over 18 months of visibility for product revenue at current run rates. That's a pretty comfortable cushion.
18 months is good visibility.
And interestingly, they mentioned they proactively canceled one unit from the backlog, about $3 million, specifically to ensure they only had high-quality executable orders in there. They're not chasing volume at any cost.
Discipline. I like that. Where's the growth coming from in that backlog and the forward look? Still international.
Overwhelmingly international. Remember, 80% of total revenue is outside the U.S. now, and the order growth reflects that. Yeah. APAC orders were up 50%.
50%. Wow.
Yeah, and Japan up 34%. Huge demand there, driven by their newer product lines, things like Helix and Tomo C.
So international is booming. What about the U.S. market? Still slow.
Orders were slower in Q4, yes.
Yeah.
But interestingly, U.S. revenue was actually up 24% in the quarter.
How does that work? Slow orders, but higher revenue.
They were successfully converting backlog booked in previous quarters. So installations were happening. Looking ahead, they expect U.S. improvement to be gradual, but potentially accelerating in fiscal 26.
What's the catalyst for that acceleration?
They're pinning hopes on new all-in-one radiotherapy solutions they plan to launch around the big ASTRO industry conference. The idea is to target the large installed base of older machines in the U.S. that are due for an upgrade.
Makes sense. Aim for the replacement cycle. Now, probably the most critical piece of guidance for anyone modeling this out, the cadence within FY26.
Absolutely crucial. Management was very, very specific here. Listen closely. H1 fiscal 26, the first half, is expected to deliver about 45% of the year's total revenue.
Okay, slightly less than half the revenue.
But only about 30% of the year's total adjusted EBITDA.
Whoa! Only 30% of the profit in the first half, that means.
It means 70% of the projected annual profit is heavily backweighted into the second half of fiscal 26.
Why such a skew?
It's tied directly to assumptions about volume trends improving through the year, and critically, those operational efficiencies really kicking in, things like maybe some initial FTZ benefits, better absorption of overheads with higher volume, and getting the full impact of pricing actions.
So the profit ramp is very much an H2 story. That's a vital context. No wonder BT raised their price target to $5 after the call. They must be buying into that H2 ramp and the execution story.
Seems like it. They're giving management credit for the cleanup and the outlook. Which brings us nicely to our segment. This is not financial advice.
Right, where we toss around an outrageous but plausible trade idea based purely on the narrative we just heard from the call. Not investment advice, just a thought experiment.
Okay, so given the stock has actually done pretty well recently compared to, say, the broader healthcare ETF, the XLV.
Yeah, the narrative seems to be shifting, right? From can they survive to can they actually execute and deliver this operational leverage?
Exactly. So the outrageous but plausible idea is this. Consider a long position in the common stock. You're essentially betting on that $5 price target being reached, maybe even sooner than expected.
Okay, long the stock, what's the specific mechanism or catalyst you're betting on hitting early?
It's a dual catalyst bet. First, you assume that foreign trade zone, the FTZ, gets implemented and starts showing benefits earlier than the official H2 fiscal 26 projection.
So faster tariff relief hitting the gross margin line.
Faster than the market is currently pricing in, yes. That's catalyst one. Catalyst two is you assume those new all-in-one radiotherapy solutions they're launching at ASTRO get immediate, strong, premium price traction.
So better than expected uptake on the new high-end product.
Right. You pair that faster cost relief from the FTZ with faster high-margin revenue from the new products. If both hit sooner than guided.
The market could quickly re-rate the stock towards or even past that $5 target as it sees the earnings power materialize ahead of schedule.
That's the thesis. The risk, of course, is the flip side. China demand could stall again, maybe Middle East issues flare up, or the FTZ implementation hits snags and gets delayed. It's a bet on management executing ahead of plan in a tricky environment.
Got it. An execution bet. So let's try and wrap this up. What's the core takeaway from this call?
For me, it was really a story of resilience. You saw the company successfully clean up its balance sheet, which was crucial, and you saw that incredibly robust service business really cushioning the blow from all the volatility in product shipments caused by, geopolitics and trade friction.
Yeah, the service strength was undeniable. But the path forward now seems entirely dependent on execution, doesn't it?
100%. It all hinges on hitting that FY26 guidance, especially that heavily back-weighted profit number.
Yeah.
They absolutely have to convert that backlog, get traction with the new products, and realize those operational efficiencies in the second half.
The pressure is on for H2 FY26.
Definitely. So as you digest all this, here's the final provocative thought we'll leave you with. The market seems to be rewarding the plan for operational fixes like the FTZ. But what if the external headwinds, the tariffs, the geopolitical friction actually ease up faster than the company can implement its internal fixes like the FTZ? Is there a hidden cost of execution risk already priced in? Or is the market maybe still underestimating the potential upside if the macro environment improves even slightly?
Interesting question. How much is the fix worth versus just the external problem going away on its own? Something to chew on.
Indeed.
Okay, that's all the time we have for this edition of Talk Tickers. Thanks for joining us on the deep dive.